Welcome to Value VestDaily. Today, we are diving right into a situation that has the entire world on the edge of its seat, the escalating crisis in Iran. We're talking military strikes, a huge power vacuum, and a direct threat to the world's energy supply. Oil is absolutely surging, and markets are, well, they're spooked. But here's the thing. While a lot of people are panicking, we're looking for opportunities. Because as value investors, we know that moments of peak fear can also be moments of peak opportunity. So stick with us. We're going to cut through the noise, analyze the fallout, and maybe, just maybe, uncover some undervalued gems in all this chaos. Okay, before we really get into the weeds, just a quick but super important note. Everything you're about to see and hear in this explainer is for educational and informational purposes only. This is not financial advice, it's not tax advice. Please, you gotta do your own research and always talk to a qualified professional before making any investment decisions, all right? Let's do this. All right, here's the game plan for today. We've got it broken down into 4 key parts to give you the full 360-degree view. First up, we'll set the scene and really get a grip on what's happening on the ground in Iran. Then we'll look at the shockwaves hitting global markets. We're talking oil, gold, the whole shebang. After that, we get to the good stuff, identifying specific value investing opportunities this crisis might be kicking up. And finally, we'll wrap it all up with the key risks and the biggest takeaways you need to know. Let's jump in. So let's kick things off with Section 1, the crisis unfolds. Look, before we can even begin to talk about investments, we have to understand the gravity of what's happening. This isn't just another headline. This is a massive geopolitical event with some really far-reaching consequences. Let's break down exactly what went down. So how did this all kick off? Well, on February 28, 2026, we saw a huge escalation. Joint U.S. and Israeli airstrikes hitting targets inside Iran. And the fallout from that was immediate. It was dramatic. It was confirmed that Iran's supreme leader, Ayatollah Ali Khamenei, was killed. Now, this is a monumental event. It's not just taking out a leader, it's effectively decapitating the regime, creating this massive power vacuum, and throwing a country of over 80 million people into chaos. Iran's response? It was fast and it was furious. They launched a barrage of missiles and drones, not just at Israel and U.S. bases, but also hitting key targets in Saudi Arabia and the UAE, basically sending a clear message to all of America's allies in the region. But the real game changer, the move that put the entire global economy on red alert, was their declaration that they were closing the Strait of Hormuz to all shipping. And that is a very, very big deal. And this number right here, this 20%, this puts that threat into perspective. We are talking about 1/5 of the entire world's daily oil supply. 1/5. And it's not just oil. It's about 1/3 of all the seaborne liquefied natural gas, or LNG. I mean, think about that. The economic lifelines for huge countries in Asia, we're talking China, Japan, South Korea, India, they are almost completely dependent on tankers getting through that one narrow waterway. So by closing it, Iran is basically holding a knife to the throat of the global energy market. It's a massive gamble, designed to cause maximum economic pain. And it's something the markets just cannot ignore. And here's the thing. We've seen this movie before. This isn't just some wild guess. If you look back at history, the precedents are really stark. Back during the Iranian Revolution in 1979, the chaos caused oil prices to more than double, and that triggered a global energy crisis. Fast forward to 1990, when Iraq invaded Kuwait. Again, the fear of a bigger war and supply disruptions made crude prices double in just 2 months. So history tells us that when this region becomes unstable, the energy markets react in a big, big way. So now that we've got the lay of the land, geopolitically speaking, let's move on to Section 2 and see how the markets are reacting. And as you can probably guess, the fallout has been fast and it has been furious. Investors everywhere are scrambling, asking the same question, where do I hide when the risk is this high? Let's break down the key market moves. No surprise here, right? All eyes are glued to crude oil. And this price chart just tells the whole story. Before this crisis blew up, we were seeing prices trading pretty comfortably in the high 60s, low 70s. And now, Brent crude has already shot past $80 a barrel. And here's the really scary part. A lot of analysts think this is just the warm-up act. We're seeing forecasts from major banks calling for $100 oil, $120, even whispers of $150 a barrel if that strait stays shut for a long time. That is a massive deal for the global economy because higher energy costs basically act like a tax on everything, right? It fuels inflation and it just squeezes everyone's wallet. So what's actually behind this crazy price spike? It's a concept that traders call the war premium. You can think of it like this. The market is adding a surcharge to every barrel of oil. Not because there's a shortage today, but because of the risk of what could happen tomorrow. It's like an insurance policy against future chaos. Right now, traders are looking at the 3 million barrels a day from Iran, plus all its neighbors, and they're pricing in the scary possibility that all of that could just vanish from the market. And that insurance policy, that pure fear, is adding about $10 to $20 to the price of a barrel right now. Of course, it's not just about oil. In times of intense geopolitical stress, money just runs for cover. And this slide illustrates that perfectly. Gold, the classic safe haven asset for, thousands of years, has absolutely surged. We're seeing prices break out, climbing up towards $5,500 an ounce. This is the absolute definition of a flight to safety trade. Investors are dumping stocks and buying tangible assets, stuff they can trust when uncertainty is through the roof. It's a huge flashing signal of just how nervous the market really is. And believe me, those shockwaves are being felt everywhere. Let's just walk through this for a sec. First, other safe havens are following gold's lead. You've got silver rallying. U.S. Treasury bonds are getting bought up, which pushes their prices higher. Even currencies like the Swiss franc are getting stronger. But on the flip side, stocks are getting hammered. S&P 500 futures are deep in the red, signaling a total risk-off mood. And the pain is especially bad for tech and high-growth stocks in the Nasdaq. Why? Well, because the threat of surging oil means higher inflation, which could force central banks to raise interest rates. And higher rates make the future profits of those flashy growth companies way less valuable today. This is the kind of event that could spark a huge rotation, with money flying out of expensive growth stocks and into cheaper, inflation-proof value sectors, like energy. And that brings us perfectly to Section 3, Value Investing Opportunities. This is where we stop just reacting to the scary headlines and start proactively hunting for bargains. Because in the world of value investing, chaos can actually be your best friend. It's when fear is at its peak that you can often find fantastic companies trading at a deep discount. So let's go bargain hunting. But hold on, before we start throwing out ticker symbols, we have to be super clear about our framework. We are not chasing trends here. We're not trying to guess where oil will be next week. We are value investors focused on timeless fundamentals. We're looking for 3 key things. 1, low price-to-earnings ratios, which just means the stocks are cheap compared to their profits. 2, high and, very importantly, sustainable dividend yields, so these companies literally pay us to own them. And 3, wide defensive moats, some kind of durable competitive advantage that protects the business no matter how crazy the world gets. So with that framework locked in, our first opportunity is a real titan in the energy infrastructure world, Energy Transfer, ticker symbol ET. This is a company that basically owns the pipes and plumbing of the American energy industry. It's a classic infrastructure play that checks all of our boxes. Let's dig into the nitty-gritty for Energy Transfer because the numbers here, they really speak for themselves. First off, just look at that dividend yield, a juicy 7.1%. That's a fantastic return you're getting paid while you wait for the market to wake up. Next, it's trading at a forward PE ratio of just 8. Now that's significantly cheaper than its peers who trade at an average of 12, so it's on sale. And its moat? Well, it's literally steel in the ground. A massive, irreplaceable network of over 140,000 miles of pipelines that just churn out steady, predictable, and huge amounts of cash. And this right here, this quote brilliantly explains the whole idea. Think of a company like Energy Transfer as a toll road for oil and gas. They don't really care about the price of the cars driving on their road. They just collect a toll for every car that passes. They own the pipelines, the storage, the processing plants. They get paid a fee for the volume that flows through their system. So, whether oil is at $70 or $120, as long as it's flowing, ET's collecting its tolls. This makes their business model a defensive powerhouse, with stable cash flows even when the energy markets are going nuts. All right, let's move on to our second opportunity. It's another absolute fortress in that midstream space that has a lot of the same attractive qualities, Enterprise Products Partners, ticker EPD. Now, what's so incredible about this slide is the track record. Just look at that distribution growth, 27 consecutive years of increasing its payout to shareholders. I mean, come on, that is the gold standard of consistency. It tells you this is a business run with incredible discipline that can navigate recessions, commodity crashes, and now geopolitical crises. It's giving you a solid 6.1% yield and trades at a totally reasonable valuation. Its infrastructure is a fortress, and that long history of rewarding shareholders makes it a really compelling name for more conservative income investors. For our third opportunity, we're going to pack our bags and go international. We're looking at a European integrated energy major, Total Energies, ticker TTE. This is a fantastic way to get exposure to higher energy prices while also adding some geographic diversification to your portfolio, which is so crucial in times like these. Spreading your bets across different regions can really help lower your risk.
The crucial point here, the magic word, is valuation. Total Energies trades at a PE ratio of just 7, and it pays you a robust 7% dividend yield. Now, what makes this so compelling is that it is way cheaper than its American cousins, like Exxon or Chevron, which usually trade at much higher multiples. This is what we call a relative value play. Plus, TTR isn't just an old-school oil company. They've got a really diversified business, with huge and growing investments in solar, wind, and LNG. This positions them really well for the long-term energy transition, no matter how this current crisis ends. So you get the upside from high oil prices today with a nice hedge on the future of energy tomorrow.
Okay, let's bring it all home with our final section. Now that we've looked at the crisis, the reaction, and some specific ideas, what are the key risks and the biggest takeaways you need to keep in mind as you try to navigate this market? Let's break it down.
When you really boil it all down, there are two main scenarios ahead of us. On one hand, you have the big risk, a prolonged war. This is the nightmare outcome. If this conflict gets wider, sucks in more countries, and that Strait of Hormuz stays closed for months, the economic damage would be severe. We're talking about a shock that could add more than half a percentage point to global inflation. That would just crush consumer spending and pretty much force central banks to keep interest rates painfully high, which hurts almost all stocks. But the more likely base case is a period of eventual stabilization. This would look like the price surge we're seeing now, but it would be followed by a gradual calming as behind-the-scenes diplomacy kicks in and other OPEC Plus countries like Saudi Arabia use their spare capacity to fill the gap. That scenario is a temporary shock, not a permanent crisis. And that really leads to the central question for all of us as investors. We've laid out the facts, the market's panicked reaction, and a few specific, fundamentally solid opportunities. But now I genuinely want to hear from you. What is your take? Are you looking at this extreme volatility as a clear signal to buy undervalued energy assets for the long haul? Or do the risks of a wider conflict, that nightmare scenario, still seem way too high to justify jumping in? There's no single right answer here, so let me know what you're thinking down in the comments. Please subscribe, like, and share Value VestDaily for daily learning opportunities before you put your money to work. And one last thing, if you want us to do a deep dive into any specific high-risk, high-reward opportunities, just drop a comment below and let us know. Thank you so much for your time today. Stay safe, stay informed, and we'll see you in the next one.